Hey everyone, today we're talking about a super simple financial tool that honestly could be earning you a whole lot more money on the cash you already have sitting around. It's called a high-yield savings account. And by the end of this quick explainer, you're going to know exactly why it's such a big deal.
But first, let me ask you something. Is it possible that your regular old-school savings account is actually costing you money? Not in fees, no, but in what it isn't doing, in lost potential. Well, for millions of people, the answer to that is a huge, resounding yes.
And here's the number that proves it, 0.4%. That's the national average interest rate for a traditional savings account. I mean, that is tiny. At that rate, your money is barely growing at all. And you know, when you factor in inflation, it means you're actually losing buying power over time.
Now, let's flip that and look at the alternative. This is a high-yield savings account, or HYSA for short. And the rates here, they aren't just a little bit better, they're often 10 times higher. We're talking 4% or even more. That difference isn't just a few pennies, okay? This is real money that you could be leaving on the table.
So here's our game plan. We're going to look at why your money might be underperforming, then we'll dive into the high-yield solution. After that, I'll show you how to pick the right account, we'll talk about the trade-offs, and then we'll wrap it all up with the key takeaway. Let's get right into it.
First up, let's make this real. What does that teeny tiny interest rate actually mean for your wallet?
Okay, check this out. Let's say you have $20,000 saved up. In a traditional account earning that national average, you'd make just $80 in interest over a whole year. 80. But that exact same money in a high-yield account earning 4%, that would net you $800. That's a $720 difference just for picking a smarter place to park your cash.
So we've definitely seen the problem. Now for the good part, the solution. What exactly is a high-yield savings account? Well, it's pretty much what it sounds like. It's a savings account, but supercharged. It's a safe place to put your money, for an emergency fund, a down payment, a big vacation, that just pays you way, way more in interest.
You might be wondering, how is that even possible? It's not magic, I promise. It really comes down to a smarter business model. See, most of these accounts are from online-only banks. They don't have to pay for expensive brick-and-mortar branches, so their overhead costs are way lower, and they pass those savings on to you in the form of higher interest rates. Simple as that.
All right, let's get practical. There are a lot of options out there, so how do you choose the right one for you? Honestly, it just boils down to a really simple 4-step checklist. Here are the 4 things you've got to look for. First, the APY. That's the annual percentage yield. You want to shoot for 4% or higher. Second, you got to hunt for fees. The best accounts have 0 monthly fees that could eat away at your earnings. Third, check for minimums. So many of the best options require $0 to open and keep open. And finally, and this is the most important one, confirm the insurance.
This one is totally non-negotiable. Make sure the bank is FDIC-insured, or if you're looking at a credit union, NCUA-insured. This protects your money up to $250,000 per person, which means these accounts are every bit as safe as any traditional bank account.
And you're going to see a lot of variety out there. Some accounts, like Varo here, might offer a killer top-tier rate, but you might need to have direct deposits to get it. Others, like Sallie Mae, are super straightforward with a great rate and no minimums. And some, like First Foundation, might want you to have an initial deposit. The point is, there's an option for pretty much every kind of saver.
Of course, no single financial product is perfect for everybody or every situation. So to give you the full picture, let's take a really balanced look at the potential trade-offs and see how HYSAs stack up against the alternatives.
So here's an honest, at-a-glance summary. The pros are huge, right? High rates, total safety, and low or no fees. The cons are pretty manageable. Rates are variable, which means they can go up or down with the market. Since they're mostly online, you won't be visiting a branch. And transfers to your checking account might take a day or two to process. And it's important to remember, this is for saving, not for long-term investing, like in the stock market, where you'd expect to take on more risk for potentially higher returns.
Now, you might also hear about something called a money market account, or MMA, that offers similar high rates. So what's the difference? Well, the biggest one is that MMAs often come with a debit card or even checks, which can be handy. HSYAs are usually more streamlined for pure saving. They're perfect for an emergency fund or saving for a goal where you don't need to be dipping into it all the time. It really just depends on what you need that cash to do.
Okay, let's bring it all home. We've covered the what, the why, and the how of high-yield savings. So, what's the one crucial thing you need to walk away with?
This quote really just says it all, doesn't it? In a world filled with complicated financial advice, this is one of the simplest, most powerful moves you can make. It's truly about making your money start working for you, instead of the other way around. So let's do a quick recap of the essentials. Number 1, your old-school savings account is probably costing you hundreds of dollars in lost earnings. 2, high-yield accounts can grow your money 10 times faster. Seriously. 3, when you're picking one, just stick to that 4-step checklist. High APY, no fees, and FDIC insurance. And 4, the easiest way to think about it is just as a smarter, higher-paying parking spot for your cash.
And that leaves us with one final thought. Remember that example from earlier? How 20 grand could earn an extra $700 or more in a year? So, what would you do with that extra money? Would it help you fund a vacation, pay down some debt, or just give you a little more breathing room and peace of mind? The opportunity is right there for the taking.